everyone. Today we are here to delve into the intricate world of dividend policy, a crucial aspect of corporate finance.
That's right, Emily. Dividend policy essentially governs how a company allocates its profit between shareholder and retains earnings for future investment.
As shareholders, understanding dividend policy is vital for evaluating investment opportunities and predicting future returns.
Let's start with the definition. Dividend policy is the decision regarding the allocation of profits to be distributed to shareholders or retained for future investments. And if distributed to shareholders, how much value will be distributed to them? Dividends is the distribution of company assets to shareholders of the company. Dividends can be paid in cash, company shares, and other assets. The board of directors must announce all dividends before they become a company obligation. Retained earnings are crucial for funding company growth, while dividends represent cash flow distributed to shareholders. Balancing growth and dividend payments is challenging because higher dividends mean less retained profit, hindering earnings and stock price growth. A high dividend payout ratio reduces funds available for reinvestment, limiting company growth.
Absolutely, Adeline. And this decision is made lightly. It involves balancing the company growth needs with the expectation of shareholders who rely on dividends for income.
Speaking of which, there are several theories guiding dividend policy decisions. Theories of dividend policy. First, dividend irrelevance theory. This theory was proposed by Merton Miller and Franco Modigliani. According to the dividend irrelevancy theory, dividend policy does not affect the stock market price of the company or the company's value. Modigliani and Miller argue that the value of a company is solely determined by the company's ability to generate income or earning power and business risk, while how to distribute income streams into dividends and retained earnings does not affect the company's value. Second, bird in the hand theory. This theory was proposed by Myron Golden and John Lichtner. According to the bird in the hand theory, dividend policy has a positive impact on the stock market price. It means that if a company distributes large dividends, the stock market price of the company will increase and vice versa. This occurs because dividend distribution can reduce the uncertainty faced by investors.
And let's not forget about the tax-preferred theory. According to the tax-preferred theory, dividend policy hurts the company's stock market price. This means the larger the amount of dividends distributed by a company, the lower the stock market price of the company. This occurs if there is a difference between personal tax rates on dividends and capital gains. If the dividend tax rate is higher, retained earnings are kept in the company to fund investment made by the company. Thus, in the future, an increase in capital gains with lower tax rates is expected. If many investors share this view, investors tend to choose stocks with a smaller dividend to avoid taxes.
Now, when it comes to type of dividends, there's quite a variety. Type of dividend according to Barrett 1, there are several types of dividends, namely as follows. Cash dividend. Cash dividend is a dividend distributed in the form of cash. One aspect that management needs to consider before announcing a cash dividend is whether the amount of cash on hand is sufficient to cover the dividends distribution. And the second, property dividend. It is dividend distributed in the form of asset other than cash. The asset distributed can take the form of a company or own securities, merchandise, real estate investment, or other forms designed by the board of directors. Third, scrip dividend. Scrip dividend arises when a company cannot pay dividends immediately due to insufficient cash balance. Consequently, the company management will issue scrip dividends, which are written promises to pay a certain amount at a future date. Discrete dividends may or may not accrue interest. And the fourth, liquidating dividends. It is dividend that partially represent the return on shareholder investment or capital. When a company distribute liquidation dividends, shareholder must be informed about the amount of profit distribution and how much constitutes a return on capital, enabling them to reduce their investment. Thus, the transaction is identical to shareholder withdrawing their capital. And the last, stock dividend. It is the distribution of additional shares to shareholder without any payment required in proportion to the shares they already hold. Stock dividends are essentially a restructuring of the company capital, while the ownership proportion remains unchanged.
Indeed. Now let's take a look at the purpose of the dividend policy. Purpose. First, to maximize prosperity for shareholders, higher dividend paid will affect the stock price. Second, to demonstrate the company's liquidity. By paying dividends, it is hoped that the company's performance will be viewed favorably by the investors, and it can be acknowledged that the company is capable of facing economic fluctuations and providing return to investors. Third, to meet the shareholders' need for a stable income that is used for consumption purposes. Four, dividends can be used as a communication tool between managers and shareholders.
Besides having a purpose, this dividend policy also has aspects. First, stock dividend. Stock dividend are dividend payments in the form of shares to shareholders. From the company's perspective, stock dividends are nothing more than corporate recapitalization. This means that distributing scrip dividends will not change the company capital amount, but only result in change to capital structure. Second, stock split. Stock split is corporate action to increase the number of outstanding shares by splitting one share into two or more, followed by proportional decrease in nominal value. Stock splits are typically undertaken by companies when the market price of the company's shares has become too high. Third, repurchase of stock shares. Repurchase of stock shares is part of dividend decisions. This decision is made when the company has excess cash, but no profitable investment opportunities. Therefore, the company can use the available funds to distribute as dividends or to repurchase outstanding shares.
Okay, next let's discuss the factors influencing dividend policy. The company funding needs. If in the future the company plans to make investment that require large amount of funds, the company can obtain them through retained earnings. The greater the needs for funds in the future, the larger the portion of retained earnings in the company, or the smaller the dividends to be distributed to shareholder. 1. Liquidity dividends can be paid in the form of cash dividend or stock dividends. The company can only afford to pay cash dividend if the liquidity level, cash ratio, held by the company is sufficient. The higher the company liquidity level, the larger the cash dividends the company can pay to shareholder, and vice versa. 2. The company borrowing capacity. One of the resources of funds for the company is through loans. The company can pay large dividends because it still has the opportunity or ability to obtain funds from loans to meet the company financial needs. This is possible because the company financial leverage is still low and the company is still trusted by creditors. Thus, the greater the company ability to borrow, the larger the dividends paid to shareholder. Third, corporate control. If a company pays large dividends, the company will likely respond by selling new shares to finance profitable investment opportunities. In such condition, the control of existing shareholders over the company may be reduced if its existing shareholders do not commit to purchasing additional newly issued shares by the company. 4. Inflation, the higher the inflation rate, the lower the purchasing power of the currency. This means that companies must be able to provide larger funds to finance the operation and investment of the company in the future. If opportunities to obtain funds from external sources are limited, one way to meet these funding needs is through internal funds, namely retained earnings. Thus, if inflation increases, dividends paid will decrease and vice versa.
For investors, understanding indicators like the dividend payout ratio and dividend yield is key to evaluating the attractiveness of dividend paying stocks. Dividend payout ratio. Dividend represents the cash flow paid to shareholders, while retained earnings are one of the most important sources of funds for financing a company's growth. Every company always desires growth on the hand and being able to pay dividends to shareholders on the other hand. But these goals are often conflicting. This is because of the dividend payout rate is higher, it means less profit can be retained, and as a result, it hampers the rate of growth in both earnings and stock price. Dividend yield. The dividend yield, expressed as a percentage, represents the income of a company pays to shareholders for each share they own, divided by the current price of the stock.
Absolutely. The use of dividend payout ratio. The dividend payout ratio is a financial ratio more commonly used by investors to access the return on their investment, and its usage is simple compared to dividend yield. Generally, the determination of dividend policy is influenced by factors categorized into two groups: financial factors including growth prospects, cost of capital, profitability, company's funding needs, liquidity, borrowing capacity, debt repay needs, dividend stability, and asset expansion rate, and non-financial factors including tax regulations, debt agreement restrictions, opportunities in capital market, corporate control, and shareholders' position as taxpayers.
In conclusion, dividend policy plays a critical role in the financial management of a company, influencing its value, shareholder returns, and market perception. Various theories such as dividend irrelevance theory, bird-in-the-hand theory, and tax preference theory offer the different perspective on how dividend decision impacts shareholder wealth and market dynamics. Company must carefully consider the several factors when formulating dividend policies, including their funding needs, liquidity, borrowing capacity, corporate control consideration, and the prevailing economic condition, particularly inflation. Additionally, indicators such as the dividend payout ratio and dividend yield provide valuable insight for investors assessing the attractiveness and dividend paying stock. Ultimately, striking a balance between rewarding shareholder with dividends and retaining earnings for future growth is essentially for maximizing shareholder value and ensuring long-term sustainability. Effective dividend policy not only signal financial healthy and stability, but also serve as a communication tool between management and shareholders, fostering trust and confidence in the company performance and prospect.
Thank you all for joining us today. As we explore the fascinating world of dividend policy, remember, understanding these principles is essential for navigating the complexities of corporate finance.